How are you all? Good? Students, as you do know that in our previous lecture, I have announced about the test for chapter number 2 only. Basically, I told you to revise IS 16, then IS 40, IS 23, and IS 20. These 4 standards I told you to revise. But today I will not be taking a test because I want you people to revise more. This time I will be giving you a homework to be done from your revision kit. In your next lecture, when you are going to sit over here, I will be assuming that you have finished that portion of revision kit which I will be telling you today. Okay, and that portion is, let me just check it. I will tell you that how many questions you have to do. From your revision kit, you have to do question number 1 to 40, question number 1 to 40, and then question number 221 to 265.
Means from 220 what?
Sorry?
Like question 1 to 40 then?
Then question number 221 to 265. This one is your homework. These questions are going to cover all those standards which we have studied earlier and which we are going to study today. Okay? So these questions are not that difficult, but they will be giving you an opportunity to revise all the concepts, and those concepts will become, lifelong concrete experience for you people then. Okay? So you will not be forgetting them then again. Now, students, today the topic with which we are going to start is an important one again. It's impairment. Impairment of assets. Your book is having chapter number 4 in regards to this topic. And in chapter number 4, we have only this standard. Okay. In regards to impairment of assets, the standard which deals is IS 36. IS 36, International Accounting Standard number 36, deals with the impairment of assets. If you can recall the earlier concepts, I told you under IS 16 and IS 40 that when the assets have to be subsequently recognized or measured in our books of accounts, we have to measure them at their cost minus any kind of subsequent accumulated depreciation and minus any kind of subsequent impairment losses. Is it? After the first year of the purchase of the non-current assets, subsequently when we have to recognize them in our books of accounts, we do account them for at this value. Cost minus accumulated depreciation minus impairment losses, specifically when we are adopting a cost model. Under revaluation model, only the difference would be in IS 16 that instead of cost, you are going to take the revalued amount. And as far as IS 40 is concerned, the difference is that there would not be any kind of depreciation under fair value model. Under cost model, we are going to treat IS 40 only on this particular parameter, but if you are using the fair value model, there will not be any accumulated depreciation. So, what is an impairment? We had slightly discussed about impairment. Now, today we are going to discuss about it in detail. Impairment is also known as a downward revaluation, or it is also known as a revaluation loss. Under IS 16, we had discussed about revaluation gain. What has been a revaluation gain? We do compare two values which have been. Yes. Good morning. When we are calculating a revaluation gain, we compare two values, carrying value and which are the value? Revalued amount or market value, is it? And whenever our revalued amount is greater than the carrying value, revalued amount, market value is greater than the carrying value, I told you people that there is a revaluation gain. This is a definition of revaluation gain under IS 16. But what is an impairment? Impairment is also known as a downward revaluation or a revaluation loss. Revaluation loss or impairment is not dealt within IAS 16. We have a separate standard to deal with the downward revaluation or the revaluation loss, which is IAS 36. Whenever there is an impairment, we do say that the carrying value of an asset is more than its recoverable amount. Please be focused on these things because everything is having a different meaning. Okay, carrying value is different, revalued amount is different, recoverable amount is different. Whenever we are dealing with impairment, we do compare two things, carrying value and recoverable amount. If your carrying value is more than your recoverable amount, it means that there is an impairment incurred in the organization. And that impairment has to be recognized in our books of accounts. Where do we recognize revaluation gain? Who can tell me? Under IAS 16, where do we recognize revaluation gain? Ask it. Excellent. Other comprehensive. I knew before that Asif would be knowing that. It's very hard working, mashallah. Revaluation gain under IAS 16 is recognized in statement of other comprehensive income. And under IAS 40, where is it recognized? Yes, Asif? SOP. Excellent. SOP. This is the difference among IAS 40 and IAS 16. Revaluation gain under IAS 16 is recognized in OCI, whereas in IAS 40 it is recognized in statement of profit or loss. Where do you recognize impairment? It will be recognized in your SOP. In order to look for impairment, you are going to see that whether your carrying value is greater than the recoverable amount or not. And if you see that carrying value is more than the recoverable amount, it means that the impairment has occurred, and straight away you are going to recognize that impairment in your statement of profit or loss. Now, what is this recoverable amount? Recoverable amount is greater of value in use, and one more thing which we are going to discuss after that. What can be a value in use? Can anyone tell me? What can be a value in use? As its name is suggesting us that it's a value which the organization is going to get by using the particular asset. So basically, value in use is the present value of cash inflows minus the present value of cash outflows. What is a value in use? The present value of cash inflows minus the present value of cash outflows. What do you think that which other thing we are going to compare our value in use in order to see the recoverable amount? What do you think? Because we are comparing different things whenever we are considering a revaluation gain or a profit or loss, or gain or loss on disposal, or if there is a revaluation and if there is an impairment. Which other thing could be there? Greater of? It's a brainstorming process. Think. Yes, anyone? It is from the previous concepts which we have discussed. Here it is. NRV. This one. NRV. It's greater of value in use and NRV. And what is NRV? Net realizable value. Who does remember IS2 inventories? What does IS2 tells us? That we have to recognize inventory at the lower of cost and NRV, net realizable value. So what is net realizable value? It's written fair value less costs to sell. Estimated selling price minus any of the costs which are necessary to make the sale possible. Say, for example, if we want to sell an asset and its estimated selling price is $200, and before to selling it, we need to rectify it. We need to renovate it little, and that renovation rectification price is $50. So $200 minus $50 is our NRV. So greater of value in use and NRV, fair value less cost to sell, we are going to take, and then we are going to compare that recoverable amount with the carrying value. If carrying value is greater than the recoverable amount, it means that there has been an impairment. This is the concept of impairment. Okay. Now, students, before moving on, one more thing which is very important in IS 36. I am elaborating all of the chapter in one go. Whatever you are going to read in this chapter, it's this one. Okay. One more important thing. Sometimes the asset on which the impairment has occurred, sometimes the asset on which the downward revaluation has occurred, has been having a revaluation gain area. It has been revalued upwards. Consider a situation that in year 2 of using an asset, you found that the revaluation gain has occurred under IS 16 of 100,000 gain has occurred, and you had recorded that gain in statement of other comprehensive income. Now in 5th year of the usage, you find that the downward revaluation has occurred, impairment has occurred. How are you going to treat this impairment now? If, say, for example, impairment loss is 200,000, 100,000 will be taken as a credit in statement of other comprehensive income up to the amount of the revaluation gain, and remaining over and above the revaluation gain recognized fair year, you are going to recognize in statement of profit or loss. This is for those assets who have been having a revaluation gain yearly. So up to the amount of the revaluation gain, revaluation loss will be recognized in statement of other comprehensive income. You are going to credit it, and remaining impairment loss will be debited over in statement of profit or loss. Okay, so this is going to be the treatment for those assets who have been having the revaluation gain in. Clear? Sometimes one more condition, analyze it. Sometimes you consider that there may be an impairment in the future. Do you remember one concept, one accounting concept which you might have studied in the earlier time of F3, that any kind of foreseeable losses have to be accounted for immediately, but not the profits. In accountancy, if you are considering that there can be some kind of losses in the future, immediately you are going to recognize them in your books of accounts, but not the profits. Which concept it has been? Excellent. Prudence concept. Prudence concept. In regards to prudence concept, if there are any kind of indicators of impairment, impairment has not occurred, but there are indicators of impairment. There is a situation, there are circumstances which are telling us that impairment might occur. Immediately, you do record impairment. But when you jump into the future, you actually find that there is no impairment. It means that the impairment which has been recognized earlier now has to be reversed. So, reversal of impairment can also occur. And reversal of impairment obviously is going to be passed through the statement of profit or loss. But the point over here which you need to note is a little bit complex. You cannot reverse an impairment more than the value of the historical cost minus accumulated depreciation of an asset. By reversing an impairment, the value of an asset should not be increasing more than its historical cost less accumulated depreciation if there would have not been any impairment. How are we going to do that? We are going to do that in this stream. So this is the total overview of the chapter. In this chapter, we are going to learn about the impairment of the assets, IAS 36. What is it? Indications of the impairment. What are the different indicators which do tell us that impairment might occur? We are going to discuss about the measurement of impairment and recognition. How do we measure impairment and how do we recognize it in our books of accounts? And in the last, we are going to discuss about impairment of CGUs, cash generating units as well. What is the objective of IAS 36 impairment of assets? They say the objective is to set rules to ensure that the assets of an entity are carried at no more than their recoverable amount. This is the language of the standard. The objective of IAS 36 is that you should not be recognizing your assets in your books of accounts more than their recoverable amount. If your recoverable amount is lesser than your carrying value, then obviously your assets have to be recognized at the recoverable amount. Carrying value would not be recognized in your books of accounts anymore. So this is the objective of IAS 36. That is why whenever there are indicators, whenever there are any circumstances which are showing that impairment might occur, you are going to compare your carrying value with the recoverable amount. And if your recoverable amount is lesser than the carrying value, it means that you are going to recognize your asset from now onwards on your recoverable amount. So your carrying value, if it's more than the recoverable amount, it's an impairment, and this is fulfilling the objective of IAS 36, that your assets should not be recognized more than of their recoverable amount. Some assets are excluded from the scenario of IAS 36. IAS 36 does not apply to all of the assets, but some assets are excluded from its overall scenario. Which one are those? Inventories. IAS 36 does not apply to IAS 2, inventories, because under IAS 2 we already have a rule that inventories are going to be recognized at the lower of cost and NRV. So they are already being recognized at the lower of cost and NRV, so we do not need to apply IAS 36 over there. So on inventories, IAS 36 is not applied. Then construction contracts, which we are going to discuss not in detail, but slightly we are going to discuss IAS 11. On construction contracts also IAS 11 does not apply. Deferred tax assets, which we are going to discuss under IAS 12 in our future lectures. On those assets also, the IAS 36 doesn't apply. Assets arising from employee benefits, IAS 19, is excluded from FR. On these assets, your impairment does not apply, and employee benefits is not the part of our syllabus also. Then financial assets included in the scope of IFRS 9, a very, not a very, but little complex standard. And nowadays it's in demand, it's in high demand as well. If you do want to look for a future in banks or financial institutions, then you should be clear about financial assets. Only by knowing about financial assets, you can get a good job in banks, etc. Anyhow, these financial assets are also excluded from the scope of IAS 36. Then investment property, because it is already measured at fair value, it is also excluded from IAS 36. And non-current assets classified as held for sale, IFRS 5, which we are going to discuss today. But these assets are also excluded from impairment. On these assets, yes, good morning. On these assets, on these list of the assets, IAS 36 doesn't apply. So primarily on which standard IAS 36 applies? IAS 16. On the property, plant and equipment, IAS 36 applies, as well as on IAS 38, intangible assets also, IAS 36 applies. On goodwill, it is going to be applied. On other intangible assets, IAS 36 is going to be applied. So primarily IAS 36 impairment of the assets applies on the tangible non-current assets, including only property, plant, and equipment, because IS 40 is not under the scope of IS 36. And then IS 38. On IS 38 and IS 16, primarily IS 36 applies. Cleared up to here? All these are also assets, but on these assets, impairment is not going to be applied, since all of these assets are having their own different kinds of the requirements which are being fulfilled within their own standards. So we do not need to apply IS 36 on these. Now, students, what is an impairment? We have discussed already. In order to consider an impairment, we do compare our two values, carrying value and recoverable amount. If carrying value is more than the recoverable amount, it's an impairment. And what is a recoverable amount? It's a greater of value in use and NRV, net realizable value. What your book says, an asset is impaired if its recoverable amount is below the value currently shown on the statement of financial position, the asset's current carrying amount. Students, the value at which the assets are being recognized in our books of accounts normally is a carrying value. How do we show non-current assets in our SOFP? Cost minus accumulated depreciation. Cost minus accumulated depreciation is carrying value. Is it? This is the value at which the assets are normally shown in our books of accounts, carrying value. And carrying value is cost minus accumulated depreciation. Is it? This is the value at which the assets are recognized in our books of accounts. When you do show your tangible non-current asset in your statement of financial position, this is the format which you do adopt. You write cost, below to that you write accumulated depreciation, and finally the carrying value is being written. So this is what they are telling you: an asset is impaired if its recoverable amount is below the value currently shown in the SOFP. What is the value at which the assets are shown in the SOFP? The asset's current carrying amount. So if at any point you see that there are indicators in which your carrying value can be more than the recoverable amount, it means that impairment has occurred. So recoverable amount is taken as the higher of fair value less cost to sell, which is NRV, net realizable value. Fair value less cost to sell is also known as NRV. And what is a fair value? Very good, excellent. The normal definition of fair value is that it is the market value. Basically, fair value is the selling price of the goods or services which we can gain in an arm's length transaction. So selling price, estimated selling price minus all the costs which are necessary to make the sale possible are going to be considered as NRV. NRV is going to be compared with the value in use. Whichever is greater will be considered as your recoverable amount. And what is a value in use? Present value of all the cash inflows minus the present value of all the cash outflows. And if the asset can be sold at scrap at the end of its useful life, that the present value of that price would also be considered in the value in use. That will be a positive cash inflow. Okay. So value in use is the present value of all the cash inflows minus present value of all the cash outflows. So you are going to compare NRV and value in use. Whichever is greater is known as a recoverable amount. If your recoverable amount is lesser than the carrying value, it means that an impairment has occurred. An impairment will be recognized where? In statement of profit or loss. Got it? So they are diagrammatically representing it as well. If carrying amount is greater than the recoverable amount, then there is an impairment. Now students, measurement of recoverable amount. Now they are going to describe that what is NRV and what is value in use, which we have already discussed. So let's read it once. Measurement of fair value less cost to sell. Measurement may be by way of a binding sale agreement. How are you going to consider the selling price or the estimated selling price of the asset under consideration? obviously there would be any kind of evidence being created in order to determine its selling price. So that evidence would be a binding sale agreement. So that binding sale agreement will be telling you that how much estimated selling price of the asset is there. Got it? And the current market price less cost of disposal where an active market exists. In the case of IS 38, intangible assets, there is no active market existing, is it? Because under IS 38, the kind of the assets which we are having are basically rights. And for rights, there is no active market present. So in that case, we have to make our own market to make the sale possible. So if we do want to see the selling price of the intangible assets, then over the evidence would be the binding sale agreement. But if we are considering the assets under IS 16, since there is already an active market present, if we do want to resale our furniture, motor vehicles, or any kind of other kind of equipment, there is a market available. So in that case, it will be the current market price less cost of disposal. Okay. Then what is a value in use? Measurement of value in use. Value in use is determined by estimating future cash inflows and outflows to be derived from the use of the asset and its ultimate disposal. At the ultimate disposal of an asset, the value at which we are going to scrap the asset can also be considered as its cash inflow. And applying a suitable discount rate to these cash flows. When we do apply a discount rate to the cash flows, what do we get? Present value. Is it? How do we get the present value? What is the formula? Future value multiplied by 1. Excellent. 1 over 1 plus r raised to the power n. Okay. So cash flows relating to the financing activities or income taxes should not be included. Is everyone clear up till here? Any kind of questions? Marva, Angelica? Both of you joined a little bit late, so if you do have any questions, please ask.
No, I don't have any.
Okay, great. Hamza, any questions?
No, miss.
Okay. Now, students, we are going to do illustration number 1 in regards to the calculation of recoverable amount. What is recoverable amount? Greater of value in use and NR, net realizable value. The requirement of the question is that what is the recoverable amount of each asset and calculate the impairment loss for each of the 3 assets. So in each of the assets, 3 assets are there, A, B, and C. In each of the assets, we have to consider a recoverable amount, and then we have to consider calculate an impairment loss. So what is the recoverable amount? Greater of value in use and NRV. So they say the following information relates to 3 assets, A, B, and C. Carrying amount is being given, NRV is given, value in use is given. In order to calculate recoverable amount, which 2 things we need to compare? NRV and value in use. The greater of both of these will be considered as the recoverable amount. In case of asset A, what is the recoverable amount? 120. Is it? Greater of NRV and value in use. 120 is the recoverable amount in the case of asset A. What about asset B? 130. And what about asset C? It is 100. So the first part is done. Recoverable amount of asset A is 120. Recoverable amount of asset B is 130. And recoverable amount of asset C is 100. Since the recoverable amount is greater of value in use and NRV. In the exam, they can ask you in both the ways. Sometimes they are going to take the name of NRV as fair value less cost to sell. Okay, so you should be remembering these concepts. Now you have to calculate an impairment loss. How does an impairment loss occurs? When your carrying value is more than the recoverable amount, then the impairment is going to occur. So in the case of asset A, the carrying amount is 100 and the recoverable amount is 120. Is there an impairment? No impairment is there. Since your carrying amount is lesser than the recoverable amount, so there is no impairment. In case of asset A, no impairment, it's nil. Is it? In case of asset B, the carrying amount is 150 and the recoverable amount is 130. Is there an impairment? Yes. There is an impairment of how much? 20,000. Why it is? Because your carrying amount is more than the recoverable amount. So it is an impairment. In the case of asset B, it is 20,000. Then in the case of asset C, your recoverable amount is 100, whereas the carrying amount is 120. Is there impairment loss? Yes. There is an impairment loss of how much? 20,000. And where do you recognize this impairment loss? Very good. In SOPL, this impairment loss is being recognized. Yes.
You said
Other comprehensive income. In the case of the those assets in which there has been a revaluation gain earlier, because revaluation gain is being recognized in statement of other comprehensive income. Up to the amount of the revaluation gain which has been recognized in statement of other comprehensive income, you are going to write the impairment loss over there, and the remaining will be taken to the statement of profit or loss. But if it's the first time when the impairment has occurred, there has not been any revaluation gain earlier, then straight away take the impairment loss to SOP. Got it? We will be coming to that concept again. Okay, it will be discussed. Have a look at this example once again, students, quickly. Yes, dear. Yes, go. Please have a look at this question once again, students. Today, at the end of the lecture, if we will be getting time, around 15 minutes, we are going to revise all of the standards which we have discussed up to. Okay, it will be a quick revision. Is it try to make notes here? Towards the end, they are going to help you a lot. So instead of reading all the book, then again, you can just, see your notes. Yes, dear.
What were you saying?
Then nothing, no impairment, no impairment. Impairment would only be in the case when carrying amount is more than the recoverable amount. Otherwise, no impairment.
Miss,
Yes, dear.
can you explain the first part?
Recoverable amount?
Yeah.
Sure. Recoverable amount is greater of carrying amount, net realizable value and value in use. Recoverable amount is greater of NRV and value in use.
Okay.
So in asset A, 120,000 value in use was greater than NRV. So it's a recoverable amount.
Okay.
In asset B, 130,000 is greater than 125. Value in use is greater than NRV. So 130 is our recoverable amount.
Okay. Okay.
And in case of asset C, NRV is greater than value in use. So 100,000 is our recoverable amount.
Okay. Thank you.
You're welcome. Please stick to this rule. This is IS 36. Now, students, we are moving on.
what if the value in use and NRV?
Sorry, but if
The value in use and NRV are the same.
value in use and NRV are the same amounts, then you can take any. You can take any. Okay, now, as we have discussed that whenever we are considering an impairment, we are going to consider the indicators of impairment. We do not start reviewing an impairment immediately. We do not start our calculations immediately in the practical life. We do not start doing this calculation immediately that whether carrying value is greater than the recoverable amount or not. First, we do see the indicators of impairment. That is why impairment is in regards to the prudence concept. Okay? It is going to be happening in the future. It's an estimate for the future. How are we going to estimate that whether an impairment is going to occur or not? We are going to consider the indicators of impairment. There are different circumstances in our environment happening which tells us that whether an impairment can be happening or not. Those circumstances which indicates that whether an impairment can occur or not are known as indicators of impairment. In the situation of few assets, we immediately start this working. Say, for example, in the case of Goodwill, say, for example, in the case of IS 38, immediately we start working. But in the case of few assets, especially IS 16, we do estimate it if there is an indicator of impairment or not. If there are indicators of impairment present, only then we are going to start this calculation, otherwise, no. So we normally say in the language of standard that if there are indicators of impairment, then we do review impairment. This is known as review of impairment. Only if there are indicators of impairment, then we are going to review impairment, otherwise leave it. Otherwise, we are not going to do that. What can be the indicators of impairment? There can be some internal indicators inside the boundaries of the organization, and sometimes there can be circumstances outside the boundaries of the organization which can tell us that impairment can happen. And all those indicators will be telling us that the market value, the recoverable amount of the asset has dropped down from the value of the carrying amount. And our carrying amount will now be more than our recoverable amount. Say, for example, the asset is becoming obsolete. The asset is becoming outdated. The asset has become what we can say some it has been broken, or something has occurred which is now bringing the value of an asset down to its carrying value. So there can be some circumstances inside the boundaries of an organization which can indicate an impairment, and there are some circumstances which are present outside the boundaries of an organization which can indicate impairment. So let's have a look at this slide. IS 36 requires that at each reporting date, what is a reporting date? A date at which the financial statements are being prepared. Year-ending date is your reporting date. IS 36 requires that at each reporting date, an entity must assess whether there are indications of impairment. Now, we focused on this point. At the end of every reporting date, you are not going to conduct impairment review, but you are going to see whether indicators of impairment are present or not. So, indications may be derived from within the entity itself, internal sources, or external involvement, that is external sources. External sources of information, number one, the asset's market value has declined more than expected. When the market value of an asset has declined, it's an indication that impairment has occurred. Then changes in the technological, market, economic, or legal environment have had an adverse effect on the entity. In the environmental analysis, we do see different aspects: technological aspects, legal aspects, environmental aspects. If any of the aspect is telling us that the market value of an asset is now going to be dropped, it means that this is an indicator of impairment. Then interest rates have increased. When the interest rates are increased, what occurs in that situation? Present value becomes, what is going to be the effect on the present value if the interest rates are increased? The present value is going to increase if the interest rates are increased. Read this point. Interest rates have increased, thus increasing the discount rate used in calculating the asset's value in use. So if that is the case, what is going to happen? Your value in use, the present value of the cash flows will increase or decrease?
It will decrease because there is discount rate.
It will decrease. The more the interest rates are, the value is going to decrease. Is it? So in that case, again, it's an indicator that the impairment has occurred. Now, internal sources of information, there is evidence of obsolescence of or damage to the asset. Change in the way the asset is used have occurred or are imminent. Evidence is available from the internal reporting indicating that the economic performance of an asset is or will be worse than expected. So in all these cases, we can estimate that the impairment might occur. So if there is any indicator present, which is telling you that might be the recoverable amount of the asset is lesser than the carried value, you are going to conduct that impairment review, and then you are going to do the calculations and you are going to report the impairment. So they are telling us in the last line, If an indicator of impairment exists, then an impairment review must be performed. So only if you analyze that any of the indicators of impairment is present, then you will start doing the calculations, then an impairment review is going to be conducted. Now, annual impairment reviews. In all the assets, in the case of all the assets, normally we first see the indicators of the impairment and then we conduct the impairment review. But in the case of few assets which are listed over here, we do conduct an impairment review at the immediate level. Immediately, with an immediate effect, we conduct an impairment review. What are those assets? Goodwill, an intangible asset with an indefinite useful life, an intangible asset not yet available for use. So we normally say, in the case of IFRS 3 business combination, goodwill, and in the case of IS 38 intangible assets, we do not look for the impairment indicators, but immediately we start conducting an impairment review. Okay, and those intangible assets with an indefinite useful life, are they amortized? No, but the impairment review is conducted for them. When we discussed IS 38, we discussed that only the intangible assets with the definite useful life are amortized. Those with the indefinite useful life are never going to be amortized, but they will be checked for the impairment. The impairment review is going to be conducted for them. And those intangible assets which are not yet available for use, those intangible assets which are not yet available for use, are they going to be amortized? When does the amortization starts? When the work from those assets is started to be undertaken. Before to that, amortization doesn't start. So where amortization has started, obviously in the case of intangible assets, IS 36 is not going to be applied. Before to their usage, and those assets, those intangible assets with indefinite useful life are going to be considered for impairment. Got it? So they are telling goodwill acquired in a business combination, an intangible asset with an indefinite useful life, and an intangible asset not yet available for use are out of the scope of the rule for checking the indicators of impairment. So let's read this slide quickly. Where there is no indication of impairment, then no further action need to be taken. Normally, we do say for property, plant, and equipment that when there is no indicator of impairment, we are not going to conduct an impairment review. But for these three kinds of the assets, even if there is indicator of impairment or not, we are going to conduct the impairment review. And those three assets are goodwill under IFRS 3, because internally generated goodwill is not going to be recognized. So this is not the goodwill normally under IS 38, it is for IFRS 3 business combinations purchased goodwill. For the purchased goodwill, we have to consider an impairment. Okay, students, I can understand sometimes the jargons which I'm using can be difficult for you to understand. But the only reason for using these jargons again and again is that you can actually try to make up your mind now, professional mind, okay? So under IFRS 3 business combinations, the goodwill, the purchased goodwill is going to be checked for the impairment. Then intangible assets with an indefinite useful life and intangible assets which are not yet available for use. IS 36 requires annual impairment reviews for these assets irrespective of whether there is an indication of impairment. And the rest of the assets, for those assets, first we have to consider the indicators of impairment. And if there are indicators of impairment only, then we are going to conduct impairment review. Clear to everyone? Now, recognition and measurement of an impairment. Where do we recognize impairment? We have already discussed it. Where do we recognize impairment? In our statement of profit or loss. There is going to be an indirect expense, which is going to be written under which head? After gross profit, what do we write? Administrative and selling costs. So under administrative and selling costs, we are going to write this impairment. Okay. So it's an indirect expense. It's not a direct expense. It is going to be written as an indirect expense in our SOPL. And recognition and measurement of an impairment. Where there is an indication of impairment, an impairment review should be carried out. The recoverable amount should be calculated. Now, my dear students, Once you come to know that the recoverable amount is lesser than the carrying value, and earlier you were recording your asset at the carrying value in your SOFP, at the time of the impairment, you now will start recognizing the asset at its recoverable amount in your books of accounts. So this is the first effect in regards to the impairment, that now onwards, the asset will not be recognized at its carrying value, but at the recoverable amount. That is the greater of value in use and NRV. So this is the first effect. And from that point of time, the asset will be depreciated from recoverable amount. The depreciation will be taken on the recoverable amount onwards. Got it? The recoverable amount should be calculated. The first thing which you have to do in regards to impairment is that you have to calculate recoverable amount. The asset should be written down to recoverable amount. The asset will be written in your books of accounts now on the recoverable amount, and the impairment loss should be immediately recognized in the statement of profit or loss. The only exception to this is that if the impairment reverses a previous gain taken to the revaluation surplus. Now, this is the point about which I was talking earlier. Here it is repeated. Where you are going to recognize the impairment loss in statement of other comprehensive income. The only exception to this is when the impairment reverses a previous gain taken to the revaluation surplus. When the revaluation gain occurs, what is an accounting entry? Debit non-current asset, debit accumulated depreciation, credit revaluation surplus. On one side, revaluation gain is taken to statement of other comprehensive income under IAS 16. And on the other side, it is taken to statement of changes in equity under the head of revaluation surplus, and in the statement of financial position as well under the head of equity. Is it? This is the treatment of revaluation surplus. So they are telling that the only exception to this is the impairment reverses a previous gain taken to the revaluation surplus. In this case, the impairment will be taken first to the revaluation surplus and so disclosed as other comprehensive income until the revaluation gain is fully exhausted. Then any excess is taken to the statement of profit. So up to the amount of the previous revaluation gain, the impairment will be recognized in the statement of other comprehensive income. If there is more impairment, then it will be recognized in statement of profit or loss. So yes, this will be tested in the examination. This is going to be tested. There is no examination in which IAS 16 or IAS 40 and IAS 36 is not being tested. These are must to come. Okay, now understanding number 1 is there. Identify the recoverable amount of the car and any impairment required. This is on the concept which we have discussed earlier. Can you do that question? Identify the recoverable amount of the car and any impairment required. Try to do it by yourself, students. With the help of that flow chart, do it. Yes, students, have you finished? Finished? Done? Great. An entity owns a car that was involved in an accident at the year end. It is barely usable. So the value in use is estimated at 1,000. What is value in use, students? It is $1,000. However, the car is a classic and there is a demand for the parts. This results in a fair value less cost to sell of 3,000. Fair value less cost to sell NRV is $3,000. So what is your recoverable amount? Greater of value in use and NRV. It's not the difference. It is the greater of value in use and NRV. So your recoverable amount is 3,000. Now come to the carrying amount. The opening carrying amount was 8,000 and the car was estimated to have a life of 8 years from the start of the year. The impairment is occurring at the year end and they are giving you the carrying amount at the start of the year. So first you have to calculate the carrying amount at the end of the year. The carrying amount at the start of the year has been carrying value at the start was how much? 8,000. And the depreciation at the end of the year would be calculated as 8,000 divided by 8 years because it is the estimated useful life from the start of the year. So 8,000 divided by 8 at the end of the year, what would be the depreciation? 1,000. 1,000 is the depreciation at the end of the year. So at the end of the year, how much carrying amount would be there? 7,000. Now compare that whether this 7,000 is greater than 3,000 or not. Is it? This carrying value is more than the recoverable amount, so okay, there is an impairment. Right? How much impairment loss will be there? 4,000. 4,000 is your impairment loss. 4,000 impairment loss will be taken to the SOPL. And now the asset will be started to be recognized at its recoverable amount from now onwards. So in SOFP, the amount of the asset that you will start writing is 3,000. This will be taken to the SOFP. See, this is going to be the treatment in regards to the impairment loss. Shall we move on? Now, students, do you want to do it, Rabia? Okay, sure. Quickly do. Finished? Great. Now, students, understanding number 2. What is the amount of impairment and how should this be treated in the financial statements? Again, you are required to calculate the amount of impairment. Do it, students. Yes, dear. 26. What? 26,000? No. 260,000. 260,000. Yes. Yes. Yes, is it finished? Try to do it. This exam you have to do alone. You will not find your teacher anywhere. Okay? So try to prepare yourself. But telling you very honestly, this exam is, you can pass it. Okay, do not be afraid of it, but hard work is required. Hard work is required. It's one of the exams which is having a higher passing ratio. Okay, let's start doing. And entity, let's read the requirement first. What is the amount of impairment and how should this be treated in the financial statement? So with the help of that flow chart, again, we are going to do this question. An entity owns a property which was revalued to 500,000 on 31st March 2003 with a revaluation gain of 200,000 being recognized as other comprehensive income. So now the situation is that on 31st March 2003, there has been a revaluation gain which has been recognized in statement of other comprehensive income. There has been a revaluation gain of 200,000, is it? This has already been recognized and recorded in the revaluation surplus. So at that time, we had passed the same accounting entry as debit non-current asset, debit accumulated depreciation, and credit revaluation surplus. But to say at 31st March 2005, after 2 years, at 31st March 2005, the property had the carrying amount of 460,000, but the recoverable amount of the property was estimated at only 200,000. So carrying value has been more than the recoverable amount. The carrying value has been 460,000, whereas the recoverable amount is 200,000. So it means that there is an impairment of 260,000. Is it? Now, how are we going to recognize this impairment? Since we had already a revaluation gain in statement of other comprehensive income. So in statement of other comprehensive income, we are going to debit at 31st March 2005. Now we are going to reverse this revaluation gain in statement of other comprehensive income. We are going to write impairment in statement of other comprehensive income. Impairment of how much? 200,000 up to the amount of the revaluation gain which has been recognized earlier. And remaining is how much? 60,000. 60,000 is taken to the statement of profit or loss. As an impairment, 60,000 will be taken to the statement of profit or loss. Okay, so 260,000, 200,000 is taken to the statement of other comprehensive income, and 60,000 is taken to the SOP. This is what we are going to do in the case of those assets which have been revalued upwards earlier. This is going to be the treatment. Yes, Ali, are you clear now? This is where I told that instead of SOPL, we have to take few part of the impairment loss for the comprehensive income as well.
Also, there was no valuation at the start, go to profit and loss.
Straight away to the statement of assets. If there would have not been any revaluation gain earlier, then take all the 260,000 impairment loss to statement of profit or loss. Yes, Samri, any question? May I erase it, students? students, a very important concept in regards to the impairment. This is a little bit complex as well. That is impairment of the assets, reversal of impairment loss. As we have discussed earlier, that impairment is just an estimation for the future. We do see the indicators of the impairment. If there is an indicator of the impairment, we write impairment loss in our books of accounts. But when we reach the future in actual, we might see that there is no impairment in actual. So in that case, we have to reverse the impairment loss. So what is going to happen? How are we going to recognize that reversal? Now we are going to study. So they say the calculation of impairment losses is based on the predictions, estimations of what may happen in the future. Sometimes actual events turn out to be better than predicted. If this happens, the recoverable amount is recalculated and the previous written down is reversed. Now here they are mentioning the steps which we can follow in order to reverse the impairment. Let's read it first. Impaired assets should be reviewed at each reporting date to see whether there are indications that the impairment has reversed. A reversal of an impairment loss is recognized immediately as income in the profit or loss. Again, the same scenario is going to be applied. If there is no revaluation gain earlier and we have impaired an asset and we have written that impairment in revaluation gain, if revaluation gain has been present earlier and there has been impairment loss. So we had recorded that in statement of other comprehensive income. Now, if we have to reverse that, again, we are going to reverse it first in the statement of other comprehensive income. If there would not have been any revaluation gain earlier and we had recorded impairment loss in statement of profit or loss, then in the case of reversal of impairment, we are going to reverse it. We are going to credit it in statement of profit or loss. So the same approach is going to be applied. They say a reversal of an impairment loss is recognized immediately as income in profit or loss if the original amount was charged. If the original impairment was charged against the revaluation surplus, it is recognized as other comprehensive income and credited to the revaluation surplus. This is complex now. The reversal must not take the value of the asset above its depreciated historical cost. That is the amount it would have been if the original impairment had never been recorded. The depreciation that would have been charged in the meantime must be taken into account. So when we are reversing an impairment loss, we have to consider that the new amount after the reversal of the impairment should not be going up than the historical cost minus accumulated depreciation cost. Consider it. Say, for example, in 2001, we had an asset of the carrying value of 200,000. In 2003, we found that it's been impairment on this asset. Impairment has occurred, and now the impairment is $50,000. The yearly depreciation which we are taking is, say, for example, $20,000. This is the yearly depreciation charge. On 2003, we have recorded this 50,000 as an impairment in our statement of profit or loss. Now in 2005, we again see that this recoverable amount is again more than the carrying value. It means that the impairment has to be reversed now. So in 2005, we see that there is a reversal of impairment. Again, the reversal of impairment is there. Previously, the impairment which has been recorded is 50,000, but now the reversal of the impairment may not be 50,000, may not be 50,000. What we are going to do in that case, we are going to see the carrying value at 2005 as per the recoverable amount before. From this point, from 2003, we had started recognizing our asset at its recoverable amount. Recoverable amount, we had started to recognize it. According to this recoverable amount, we are going to calculate the carrying value at 2005, and we are going to consider one more carrying value as per historical cost if there would not having any impairment. So we are going to calculate one more carrying value which would have been if there was not any impairment. So we are going to calculate the carrying value. We are going to take the cost at 2001, that is 200,000. Then we are going to deduct the yearly depreciation charge. So from 2001 to 2005, 1, 2, 3, 4, 5. 5 years depreciation is there for 20,000. So it means that 100,000 is your depreciation. Is it? So the carrying value without depreciation is 100,000. You are going to compare both of these, and only the difference is going to be taken as reversed impairment loss in your statement of other comprehensive income or in statement of profit or loss. This is going to make your questions easy. These steps you are going to follow when there is a reversal of impairment. You are going to calculate two carrying values, one with the impairment and the other without the impairment. And only the difference will be taken as the reversal of the impairment, not the actual reversal. The actual reversal is 50,000. You have to reverse this impairment, you can. But obviously, all of this amount cannot be reversed since it cannot be revalued upwards more than the amount of the historical cost minus accumulated depreciation. So simply, you are going to calculate both of these values. You are going to compare them, and the difference of these will be taken as the impairment. Clear? They say in the last bullet point, the depreciation charge for the future periods should be revised to reflect the changed carrying amount. Now in the future, again, the amount, the recoverable amount which you have calculated is going to be recognized in SOFP, and on that amount, you will start taking the depreciation. They say an impairment loss recognized for goodwill. Now in the case of goodwill, the impairment loss which you have taken is not going to be reversed. For goodwill, the impairment which has already been taken is never going to be reversed. What is the concept behind it? If, say, for example, consider a situation, you are purchasing a business and you have paid that particular business more than their amount of the net assets. The amount which you are paying over and above the value of the net assets is because of the goodwill. That is the purchased goodwill. How do you calculate the goodwill? Consideration paid minus fair value of the net assets of the subsidiary at the time of acquisition. This is goodwill. This goodwill is being paid to the owners of the business because of their goodwill which they have maintained over the passage of time. Now, if this goodwill is being impaired, it means that your business, when you have purchased the other business, your business is now not able to maintain that goodwill. So the goodwill is impaired. You are going to recognize it in statement of profit or loss as your expense. Once it has been impaired, it is never going to be reversed. Because it is going to be reversed, it means that your internally generated goodwill is recognized. Now, if it is going to be reversed, it means that the goodwill which is being taken to your statement of profit or loss or your intangible asset in SOFP is because of the internal generation of the goodwill. And internally generated goodwill is never recognized. So that is why the goodwill once impaired, the purchased goodwill once impaired is never going to be reversed. So this is what they are telling. An impairment loss recognized for goodwill cannot be reversed in a subsequent period. The reason for this is that once purchased goodwill has become impaired, any subsequent increase in its recoverable amount is likely to be an increase in the internally generated goodwill, rather than the reversal of the impairment loss recognized for the original purchased goodwill. Internally generated goodwill cannot be recognized. Students, here they have written the indicators of the impairment reversal. These are just opposite to the impairment indicators. So when you have to reverse the impairment, it means that the market value of the asset now seems to improve. Okay, so external indicators of an impairment reversal are increase in the asset's market value, favorable changes in the technological, market, economic, or legal environment, decreases in interest rates. And internal indicators of an impairment reversal are favorable changes in the use of the asset, improvements in the asset's economic performance. So these are just opposite to the indicators of the impairment. Now we have this illustration 2. Before starting this illustration number 2, try to jot down all the points which we have discussed up till now in IS 36. Take your time, start to rethink that what we have studied up till. And then we are going to do this question.
Before you said something about historical cost.
Sorry?
Before you said something about historical cost.
About which thing?
Historical cost.
Historical cost. Yes.
Yeah, what was it?
I will be explaining it once again when we are going to do this illustration. You just read this and try to think what I have told you over here. Okay, in regards to the reversal of impairment. Okay, students, now we are going to take a break. After the break, we are going to continue. Fine? Okay, my online students? Now, students, we are going to start with the illustration 2. Ali has not come yet. Okay. Let us just wait for him for another 1 minute. Students, how are you finding F7? Easy, difficult, neutral? Neutral? Sometimes easy, sometimes difficult. Start doing the revision kit. Now the questions which I will be telling you, you need to do those, okay? Okay, let's start doing. The requirement of the question is explain with supporting computations the impact on the financial statements of the 2 impairment reviews. Students, if you don't mind me, please call him. I don't want him to lose the concept. The requirement of the question is explain with supporting computations the impact on the financial statements of two impairment reviews. So they are clearly stating that in the illustration being given above, there are 2 times impairment review being happening. So what is going to be the impact of this impairment on the financial statements? You have to show with the supporting calculations. Boxer purchased a non-current asset on 1st January 2001 at a cost of $30,000. So on 1st January 2001, an asset has been purchased with the cost of, yes, dear, sure. Ali, we have just started doing this question, okay? The requirement of the question is to, with the supporting computations, you have to show the impact of the impairment reviews in the financial statements, okay? So Boxer purchased a non-current asset on 1st January 2001 at a cost of $30,000. So on 1st January 2001, an asset has been purchased at a cost of $30,000. At that date, the asset had an estimated useful life of 10 years. So at this date, on 1st January 2001, the useful life of the asset has been 10 years. Boxer does not revalue this type of the asset, but accounts for it on the basis of depreciated historical cost. So depreciation at the historical cost means that cost minus residual value divided by estimated useful life of an asset. At 31st December 2002, the asset was subject to an impairment review and had the recoverable amount of $16,000. So first time the impairment review has been occurred. This is the first impairment review. At 31st December 2002, that impairment review has occurred, and we found that now the recoverable amount is $16,000. So at 31st December 2002, after 2 years, the impairment review has occurred, and we have found, Boxer have found that recoverable amount is now $16,000. So how much impairment we are going to take to our financial statements in regards to this impairment review? Can anyone tell me? Recoverable amount is there. We have to calculate the carrying value at this stage as well. We are going to compare both of those amounts, and the difference would be taken as an impairment in our SOPL, if any. Okay, so we are going to calculate the carrying value at 31st December 2002 as well. It's not being given in the question, is it? So carrying value is cost minus accumulated depreciation. Cost has been 30,000 minus accumulated depreciation from 2001 to 31st December 2002. 2 years have passed. Estimated useful life has been 10 years. Per year depreciation charge is 3,000. 30,000 divided by 10 years because there is no residual value. So cost divided by estimated useful life is annual depreciation charge. So 3,000 for year ending 31st December 2001 and 3,000 for 31st December 2002. Total depreciation charge up till 31st December 2002 is 6,000. So carrying value is how much? $24,000. Now compare carrying value with the recoverable amount. Is your carrying value more than the recoverable amount? Is your carrying value is more than the recoverable amount? Yes. So it's an impairment. Impairment has occurred. How much impairment is there? At 31st December 2002, impairment is 24,000 minus 16,000. 8,000 is your impairment. At 31st December 2002, you must have taken this 8,000 to your SOPL as an impairment. Moreover, from this date onwards, your asset will be classified at its recoverable amount, 16,000 in your SOL. This is the treatment of impairment, is it? Whenever we are seeing that carrying value is more than the recoverable amount, you have to start recognizing your asset at the recoverable amount in your books of accounts at the time of the impairment. And at the other place, 8,000 impairment will be taken to the SOP. This is the impact of the first impairment. Okay. Then at 31st December 2005, after further 3 years, 2003, 4, and 5, the circumstances which caused the original impairment to be recognized have reversed. So now the actual indicators have reversed and no longer applicable, with the result that the recoverable amount is now 40,000. So at 31st December 2005, 31st December 2005, there is again an impairment review in which we have found that the recoverable amount is now 40,000. So again, we have to see that whether there is an impairment again happening or not. They have told us that we have to reverse the impairment, but still we are going to check whether there is an impairment again happening or not. So carrying value at 31st December 2005, we have to calculate in order to see whether impairment is there or not. So carrying value at 31st December 2005 would be how much? At which amount we are going to take the depreciation from this date onwards? From 16,000, is it? That is the treatment after the first impairment. So 16,000 minus accumulated depreciation up till 31st December 2005. So from 2002 to 2005, we have to take the depreciation on 16,000. How much per year depreciation charge will be there? When we had reached 2002, 2 years have passed. Out of 10 years, 2 years have already passed. Now at 2005, how many years have been passed from 2002 to 2005? 3 years have been passed. And 16,000 is going to be divided on how many years? 8 years in order to calculate the depreciation charge. Because at this time, 2 years have already been passed and remaining are 8 years. So 16,000 divided by 8 per year depreciation charge has been 2,000. Is it? Per year depreciation charge from this date onwards, depreciation charge has been 16,000 divided by 8 years. 2,000. So 2,000 depreciation charge for year ending 2002, 2,000 for year ending 2003, for 2003, 2004 and 2005. For 3 years depreciation charge has to be taken. So how much depreciation charge will be there? 2 multiplied by 3, it will be 6,000. So how much is going to be the carrying value now? 10,000. Is there an impairment now? Is your carrying value more than the recoverable amount? No. So no impairment has been there. And they are telling us that the original impairment has to be reversed. What has been the original impairment? This has been your original impairment. But we have learned a concept that all of the impairment could not be reversed. We are going to reverse only the amount up to the historical cost minus accumulated depreciation, not more than that. So now what we are going to do, this is very important from exam point of view. This is how you are going to tackle your exam questions. Your original impairment which you can reverse is 8,000, but you cannot reverse it all. At this point of time, this carrying value has been calculated, which is in regards to the impairment. This is going to be carrying value at 31st December 2005. One more carrying value you are going to calculate, carrying value at 31st December 2005 without impairment. If there would not have been any impairment, then what would have been the carrying value? That is historical cost minus accumulated depreciation. So historical cost has been 30,000. Is it? 30,000 has been historical cost minus accumulated depreciation if there would not have been any impairment. So the estimated useful life has been 10 years. 30,000 divided by 10,000 for 10 years. How much per year depreciation is there? 3,000. 3,000 from 2001 to 2005. How much it is? How much it will be? 15,000. Is it? 3,000 multiplied by 5. 5 years are there. 2001, 2, 3, 4 and 5. We are at year ending 31st December 2005. So 3,000 multiplied by 5. The depreciation is 15,000. I will write it. This one is historical cost. And this one is depreciation on historical cost. So now the Carrying value without the impairment would be how much? 15,000. Got it? Now you are going to compare two values, this 15,000 and this 10,000. The carrying value without impairment is more than the carrying value with impairment. And the difference of these two values only can be reversed from the impairment. More than that, we cannot reverse. So how much can be reversed? Reversal on impairment would be 15,000 minus 10,000. Only 5,000 impairment loss would be reversed. We cannot reverse all of this 8,000, but we are going to reverse only 5,000. Clear? And where are we going to account for this reversal of the impairment loss? In our statement of profit or loss, if we have not taken it through the revaluation gain in other comprehensive income. If the previous impairment has been through the other comprehensive income, then this reversal would also be from the other comprehensive income. If not, then take it away simply as a credit to statement of profit or loss. And from now onwards, from this date onwards, you are going to recognize your asset at which price? At this recoverable price. Recoverable amount, 40,000. In your SOFP from 31st December 2005, this is going to be recognized at 40,000. Clear? Now have a look at this question and see what has happened. Apply the same approach in your examination, your questions will become easier for you. Students, in your book, they have not calculated the things in this way. So you will be confused only if you are going to see the solution in the book. Please try to look for this one, okay? I can share it in the group as well. So my online students can make this helpful. Yes, students, understood? Shall we move on? If you need more time, you can. No? Now, students, the next discussion under IS 36, which we are going to do, is in regards to the cash generating units, shortly known as CGUs. Sometimes there are the assets of the small amount in the organization. Like if you can consider a restaurant. In a restaurant, there are items which can be collectively called as the asset, but the individual recognition would be very difficult in the books of accounts. Say, for example, they do have a lot of knives, they do have a lot of ovens. So instead of taking all those assets individually, we do collect them all, and collectively we do call them as cash generating units. So in a restaurant chain, one restaurant assets of that restaurant will be called as a cash generating unit. Okay. Now the principle of impairment is going to remain the same in the case of cash generating units as well. We are going to compare carrying value with the recoverable amount. If carrying value of all the cash generating unit is more than the recoverable amount of all the cash generating unit, then there is an impairment. But how are we going to measure it? And how are we going to recognize it? That thing is going to be different. So let's have a look at this portion now. Definition of cash generating unit. A cash generating unit is defined as the smallest identifiable group of assets that generates cash inflows that are largely independent of the cash inflows from other assets. When assessing the impairment of the assets, it will not always be possible to base the impairment review on the individual assets. How are we going to review all the assets and we are going to see that whether the impairment has occurred or not? So we do collect them all, we do collect all those assets, and collectively we do see that whether the impairment has occurred or not. So the value in use calculation may be impossible on the single asset because the individual asset does not generate distinguishable cash flows. If we have to see that one oven in the restaurant is generating how much cash inflow we are getting through usage of the one oven in the restaurant, are we able to get that? So we are going to see that how much value in use collectively all the restaurant assets is given to us. In this case, the impairment calculation should be based on CGU, cash generating unit. So the impairment calculation, the principle is going to remain the same. If carrying amount is more than the recoverable amount, this is the impairment. The impairment calculation is done by assuming the cash generating unit as one asset, comparing the carrying amount of the CGU to the recoverable amount of the CGU. As previously, an impairment exists when the carrying amount exceeds the recoverable amount. And students, what is the recoverable amount? Greater of value in use and NR. Very good. Now, impairment of CGU. How are we going to account for the impairment of CGU? If you find that the carrying value of the CGU is more than the recoverable amount, how are you going to account for it? Students, in the first case, the asset which is impaired as a whole, the impairment is going to be set against that. If, say, for example, in the cash generating unit, there is one particular asset which has been impaired completely. First, we are going to set against a portion of all the impairment against that. Once it is going to become nil, then we have to set the impairment against the purchased goodwill. If there is any goodwill, we are going to set the impairment loss against that. If still the impairment is present, then on the remaining assets of the cash generating unit, we are going to apply the impairment. We are going to take the impairment on those on the pro rata basis. It means that as per their carrying value, which is being shown in the SOFP, we are going to give the portion of the impairment losses to those. So this is what they are telling us. Deal with any specifically impaired assets first that impair the CGU. IS 36 requires that an impairment loss attributable to CGU should be allocated to write down the assets in the following order. First, we are going to set it against the purchased goodwill. Then the other assets, including other intangible assets in the CGU on pro rata basis, based on the carrying amount of each asset in the CGU. Note, no individual asset should be written down below its recoverable amount. This means that unless specifically impaired, current assets are unlikely to be impaired as a part of the CGU. Now, when you are going to set off the impairment loss against the assets, sometimes they will be giving you the net assets. What are net assets? The excess of assets over to the liabilities. So those assets or those current assets are not going to be impaired specifically because current assets are normally out of the scope of IS 36. Under IS 2, or we are going to see in the other standards, if it's cash or anything, we are not going to set against the impairment loss for those assets. So those are going to be excluded, as they are already likely to be carried at their recoverable amounts. We are already recognizing inventories and other current assets at their recoverable amounts, isn't it? So that is why we are not going to set against the impairment loss for the cash generating units for their current assets. Inventory, as noted above, is outside the scope of IS 36. So not only inventory, if it's construction contracts, IS 11, or deferred tax assets, IS 12, or all those assets which we have discussed earlier are not going to be having any kind of set off of the impairment loss in CGU as well. Now, understanding number 3 is there. Sometimes these type of the questions can be asked to you in the multiple choice questions. Full-fledged type of the question doesn't come from this area. Okay, show the impact of the impairment on 1st January 2008. Said company runs a unit that suffers a massive drop in the income due to the failure of its technology on 1st January 2008. The following carrying amounts were recorded in the books immediately prior to the impairment. So prior to the impairment, the carrying value of the assets in the books of accounts of said company were like this: goodwill, technology, brands, land, building, other net assets. The recoverable value of the units is estimated at $85 million. The technology is worthless following its complete failure. The other net assets include inventory and receivables. It is considered that the carrying amount of other net assets is a reasonable representation of their NRV. Now, my dear students, 2 important points they have told us in the notes. The first one is that this impairment is making the technology completely worthless. So this technology is now completely worthless. So first, we are going to set against the impairment loss to this technology in a in a whole manner. Then the other net assets include inventory and receivables. It is considered that the carrying amount of other net assets is reasonable representation of their NRV. So on the net assets, we are not going to take any kind of impairment because it is including inventory and they are already presented on the NRV. So we are not going to take any impairment loss against the other net assets. In the exam questions also, you are going to exclude other net assets from your goodwill setting off if it is being mentioned. Okay. Now, students, how much impairment, how much recoverable amount is there? 85 million is there. And what is the carrying value? First, we have to see that whether there is an impairment or not. So we are going to compare carrying amount with the recoverable amount. So what is the total carrying amount? Calculate and tell me. Calculate carrying amount in total. 155. 20 plus 5 plus, have you calculated all? So 20 plus 5, 25, then 35, and then 75. So it's 155. 155 million is our carrying value. Now, carrying value is more than the recoverable amount, is it? Carrying value is more than the recoverable amount. Carrying value is 155,000, whereas recoverable amount is 85 million. So how much is the impairment? Impairment is how much? 70,000? 70 million? Are you sure? 155 minus 85? 70,000? Now, students, what are we going to do with this? What should we have? Yes, Stephen? Oh, sorry. Okay, 70. Now, are we going to do that? First, we are going to see the asset which is impaired completely. Technology is impaired completely. So first, we are going to set this impairment loss against technology. So 5 million is going to be set against first. Remaining is $65 million. Then what we have to do? Secondly, we have to set it against goodwill. So against goodwill, we are going to set it against 20 million is going to be deducted again, and the remaining impairment is how much? $45 million. Is it? Now what we have to do next? The remaining impairment has to be set against these 3 assets: brand, land, and buildings. Other net assets are excluded. So we are going to set it against 3 assets: brands, land, and buildings. The carrying value of the brands is 10 million, then 50 million is of land, and 30 million is for buildings. Now you have to set it against the 45 million is going to be set against all of these assets. So total of the carrying values is how much? $90 million. This 45 million is going to be set against these 3 assets on the pro rata basis. So are we going to set it against brands? 45 million divided by 90 multiplied by 10. How much will be there for brands? 45 divided by 90 multiplied by 10. Right. 5, that is impairment. Okay, then the next one, land. 45 divided by 90 multiplied by 50. How much it is? 25. Then buildings, 45 divided by 90 multiplied by 30. 50? 50. So it will be total of 45 million, which is being settled. Okay, now you have considered that impairment should not be bringing down the carrying value at 0. Okay, it should not be more than the carrying value. If, say, for example, your impairment is becoming 15 million, then you are going to set the impairment only up to 10 million. Okay, not more than the carrying value, because carrying value cannot be into a negative one. Got it? So this is how we are going to calculate it. So this is how we are going to set against the impairment in the case of the cash generating units. Have a look at this question once again. Final answer, they have asked you, show the impact of the impairment on 1st January 2008. 40, no, not 45, they have just asked you about this whole scenario. How are we going to show the impact of the impairment? Yes, students, shall we move on? Now, students, understanding number 4 and understanding number 5 you have to do from your homes. Understanding number 4 we are going to do right now, but again you have to do it from your homes as well. Okay, so I'm opening understanding number 4 from your books now. These type of the questions now can come in the last portion. Okay, in the case of the last portion, comprehensive response questions are going to come, constructed response questions are going to come. So these type of the questions are going to come. Look here, the trial balance is being given and you are required to prepare the statement of profit or loss for the year to 30th June 2007 and the statement of financial position at that date. Students, in F7 we do know that which kind of the constructed response questions does come. You can note it. Either you will be required to prepare any of the financial statements, or you will be required to prepare the consolidated financial statements. Financial statement of any kind can come. Statement of cash flows, statement of profit or loss, statement of financial position, or statement of changes in equity. Either these questions are going to come, or you will be required to prepare the consolidated financial statements. And one important and comparatively easier constructed response question is must to come in F7, that is ratios calculation. Ratios calculation. I think you have done ratios to little extent. Is it? Are you familiar of ratio calculation? So that full-fledged question does come in F7. So that is comparatively easier, but that is must question. So from these questions, you get a chance to pass F7. Okay, now the only reason for doing this question in front of you is that you can just make a basic concept of preparation of financial statements through our trial balance. Ali, when are you going to start taking the revision classes? Okay, your dad is going to decide?
Yeah.
Okay, understanding number 4, students. So this is the question which will be telling us about the preparation of the financial statements out of a given trial balance. As you can see, the requirement of the question, prepare the statement of profit or loss for the year to 30th June 2007 and the statement of financial position at that date. Students, soon after having a look at this particular point, you need to establish that what is your reporting date. Your reporting date is 30th June 2007. So your reporting year is from 1st July 2006 to 30th June 2007. How do you determine the year starting date? 1 month and 1 day after and 1 year earlier. So it is post July 2006 to 30th June 2007. And you are required to prepare the statement of profit or loss and statement of financial position for Hume Limited. So Hume, statement of profit or loss for the year ended 30th June 2007. And your year is 1st July 2006 to 30th June 2007. And you are required to prepare the statement of financial position as well. Anyhow, this is a trial balance. It's in regards to the impairment of assets primarily, but all the other concepts are also being discussed in this one. The following trial balance relates to Hume at 30th June 2007. Revenue. Revenue is going to be reported first in our statement of profit or loss, is it? So the first line item is revenue. How much revenue is there? 390,000. We are going to make 2 columns. And in the outer column, we are going to write our revenue. 390,000 is our revenue. Then they have given us cost of sales. Cost of sales are 210,600. So we do deduct cost of sales from the revenue. So we are going to write cost of sales in the internal column. So if there would be any kind of adjustments, we can do this. Okay. So cost of sales are 210,600. Then distribution costs are there. We do know that after calculation of gross profit, we can write gross profit little bit below. Gross profit, we do write the distribution and administrative costs. So distribution costs are how much? 6,800. Students, if I do any mistake, you tell me. 6,800 are distribution costs, and then we do deduct administration expenses, 12,700. Then we have non-interest paid. After do calculation of this, we do get profit before interest and tax, is it? And then we do deduct finance cost or interest expense. Interest expense being paid is 3,600. There can be an adjustment in this as well. If there is any kind of accrued interest, obviously we have to add it. So again, we are going to write it in the internal column. 3,600. Then we have property at cost. Property depreciation at 1st July 2006 is already being given. Students, over here we can start making our SOFP so that any item of the SOFP we can write here. Okay. So what is the format of SOFP? New statement of financial position as at 30th June 2007. So we can make 2 columns. First, we are going to start with non-current assets. Under our non-current assets first, which they have mentioned is property. Property at cost. Property at cost is there, 150,000. And property depreciation at 1st July 2006. At the start of the year, accumulated depreciation is 38,400. Students, usually in the exam situation, you do not write this accumulated depreciation straight away over here. You calculate the depreciation for the current year as well, and their collection is written as a whole in statement of financial position. But just because I do want to make it a little bit quick, I will write this depreciation over here, and then afterwards I will write the depreciation of the current year also. Okay, so accumulated depreciation at 1st July 2006? How much it is? 38,400. Then we have plant and equipment. We are going to write it as well. Plant and equipment cost is 176,200. And accumulated depreciation at 1st July 2006 is how much? 48,600. Then we have trade receivables. Trade receivables are mentioned under current assets. I think our balance sheet would not be fit over here. So under current assets, we have trade receivables. Trade receivables are 31,600. We can write these in the internal column again if there would be any adjustment. Trade receivables 31,600. Inventory at 30th June 2007. Normally, students, the inventory which they are giving in the trial balance is the opening inventory. Inventory which they are giving in the SOFP is which one? Is closing inventory. But over here, they are giving the inventory at 30th June 2007. This is the closing inventory. But my previous students just know this fact. I'm not familiar about the other ones, whether they know or not. The items which are present in trial balance just have only one adjustment. They go only on one place. But the items which are present in adjustments are going to have two impacts. So if this closing inventory is present in your trial balance, it will be having only one impact. It will be going only in the statement of financial position. It will not go to the cost of sales. In cost of sales, it has already been accounted for. But if this inventory, closing inventory is present in adjustments, then you have to take it to the cost of sales, you have to deduct it from cost of sales, and you have to take it to the current assets as well. Okay, so this is closing inventory because they have mentioned it is at 30th June 2007, 18100. Now, students, these are the older concepts. We are not telling you these concepts in this book. We are expecting that you know them already from your F3. So now closing inventory also goes to the current assets. Closing inventory of how much? 18100. Then we have bank. Bank also goes in the current assets. How much it is? 1950. Then we have trade payables. Trade payables come in the current liabilities. Trade payables are how much? 25,400. So 25,400 are our trade payables. Then we have ordinary shares, share premium, 12% loan note. Students, we can write it over here. Equity portion we can write here. Under the head of equity, we take ordinary shares. Ordinary shares are for 50,000. Then we have share premium. Under equity, which things we do take? Equity and all the results. The share premium also we take over here, 9,000. Then we have 12% loan note issued at 1st July 2006. This will be going to the liabilities. Loan is liability. 12% loan note which is issued at 1st July 2006. At the start of the year, it has been issued. So it will be going to the current liabilities. Loan of 40,000. If it has been issued at the start of the year, how much interest would happen on it? 40,000 multiplied by 12%. 4,800. Is it? 4,800 interest must happen there for full year. From 1st July to 30th June 2007, full year interest of 4,800 must have been there, but loan interest paid has been only 3,600. Is it? So it means that accrued interest is there. Ali, look, 12%, this is the percentage of the interest rate. Total loan issued at the start of the year, 1st July 2006 has been 40,000. 40,000 multiplied by 12%, the loan interest has been 4,800. Is it? Loan interest? $40,000 multiplied by 12% for full year is 4,800. But interest paid. Paid interest has been 3,600 only. We have paid only 3,600. It means that remaining how much? 1,200. 1,200 is accrued interest. Accrued interest is an interest which has become our liability, but we have not paid it yet. Okay, so we had to pay this full amount, but we have not paid it. So we are going to take it to our expenses. Our expenses are going to increase by this amount, and it is going to be written as our current liability also. So in current liability, students, this loan has to be written in the non-current liabilities basically. So here we can mention non-current liabilities as well. Accrued interest of 1,200 will be taken to the current liabilities. Together with that, this accrued interest has to be taken to our administrative expenses as well. Basically, you have to show this all in your workings. Accrued interest of 1,200 will also be taken here. Then students, we have taxation. This is again, over here in IS 12, we are going to discuss the concept of taxation in detail in our next few lectures. But taxation is written in the trial balance. What is it? Is it an estimated tax for the year? Where is estimated tax normally written? And where does the estimated tax goes? Is recognized in our financial statements. Students, estimated tax is the current year estimated tax, which is written in the adjustments. Estimated tax goes at two places: in SOFP under the head of current liabilities, and in SOPL under the operating profit. Okay, in the last we do deduct tax as well. The tax which is written in the trial balance is the provision of the tax. In our F3, I told you, my older students, the tax which is written in the trial balance is the provision of tax. Do you know the concept of under and over provision? If it's an under provision, the taxation which is written on the debit side is under provision. If it's written on the credit side, it's an over provision. What is the treatment of the under provision? Under provision goes only at one place. It is added to the current year estimated tax in SOPL. This is the treatment of taxation. So the tax which will be written in the trial balance is your provision. If it's written on the debit side, it's under provision. If it's written on the credit side, it's over provision. Under provision is added to the current year tax, so our tax is going to be increased. Over provision is going to be deducted from the current year tax, so our current year tax would be decreased. Got it? So taxation 1,300 after interest expense. We do get profit before tax, and then we do deduct tax expense. So tax expense estimation, we are going to see how much it is, and in that taxation we are going to add our under provision as well. Under provision is 1,300. So we are going to see in the adjustments that how much current year taxation is there. Then students, we have retained earnings at 1st July 2006, opening retained earnings. Where do we write opening retained earnings? Basically the retained earnings, closing retained earnings just go under the head of equity. So in the opening retained earnings, we do adjustments, we calculate closing retained earnings, and we derive it in our equity. So retained earnings are how much? Opening retained earnings 11450. In this one, if there is a profit for the year, we are going to add it. If there is a loss for the year, we do deduct it. If there is any dividend paid, it is going to be deducted out of it, and we are going to get the closing retained earnings, which have to be written in equity. So we are done with the trial balance. Now we are going to see the adjustments. Is everyone clear up to here? Yes, Ali? Now, students, the following notes are relevant. Number one, property includes land at a cost of 30,000. In this total property, they are telling us that land at a cost of 30,000 is there. Why are they distinguishing among all the property and the land? Because on land, there is no depreciation. Okay. Property includes land at a cost of $30,000. The building is being depreciated on a straight line basis over its useful life of 20 years. So the building is going to be depreciated on the straight line basis over its estimated useful life of 20 years. So the property of total property of 150,000, we are going to deduct. Students, over here I am calculating it, okay? Depreciation. On property. Property cost is 150,000. Out of it, we are going to eliminate the element of land, 30,000. Remaining is 120,000. And on this remaining 120,000, we are going to take the depreciation. The estimated useful life is 25 years. So 125,000 divided by 25 years. How much per year depreciation charge would be there? How much? 4,800. So 4,800 is our depreciation charge for property. So this depreciation charge for current year is going to be taken as 4,800. We are going to deduct it as well. And this depreciation has to be taken to our administrative expenses as well. Students, in the examination, this working, please show in the notes. Okay. Do not show it on the face of the statement of profit or loss, because in the classroom we cannot maintain that decorum. That is why I am doing this. Okay. So here I am going to deduct depreciation on property. How much it is? 4,800. In examination, what you will be doing? You will be writing administrative expenses. You will be showing working one. In your notes, working one, you are going to show all of this and the collective amount of administrative expenses you are doing. Okay. Then students, next bullet point, plant and equipment is depreciated on the reducing balance basis at the rate of 20% per annum. Now on plant and equipment, we have a depreciation on reducing balance basis. So when we are using the reducing balance basis, we have to calculate the depreciation on carrying value of an asset. So now we can calculate the depreciation on plant and equipment. Plant and equipment carrying value at the start of the year has been how much? 176,200 minus 486,000. 176,200 minus 486,000. How much carrying value is there? 127,600. Now on this we are going to calculate the depreciation charge. 127,600. Depreciation charge is 20%. Calculate it. 127,600 multiplied by 20%. Sorry. 25520. 25520 is the depreciation charge. So depreciation charge for current year is how much? 25520. The next bullet point. The balance on the property, plant and equipment included a piece of specialist machinery that cost 70,000 on 1st July 2005. 1st July 2005 is 2 years earlier than our reporting date. On 30th June 2007, forklift truck reversed into machinery, causing severe damage. Hume has identified two possible options. Now there is an indicator of impairment. Is it? Indicator of impairment is there. On 30th June 2007, a forklift truck reversed into the machinery, causing severe damage. When this event has happened, it is going to give us an indication that impairment might occur. So at the same moment, when there is an indicator of impairment, we have to compare carrying value and recoverable amount. So two options are there: sell the machine or repair the machine and continue to use it. So sell the machine is going to give us the fair value less cost to sell, NRV, and repair the machine and continue to use it will give us the value in use. Is it? When there is an indicator of impairment, we have to compare two values. Carrying value and recoverable amount. And recoverable amount is greater of value in use and NRV, that is fair value less costs to sell. Now the first option is to sell the machine. A potential buyer has been allocated who has indicated that she would pay 80% of the carrying amount at 30th June 2007. First, calculate the carrying amount of that part of the plant and equipment at 30th June 2007. The balance on the plant and equipment included a piece of specialist machinery that cost 70,000 on 1st July 2005. On 1st July 2005, its value has been, its cost has been 70,000. So it has been used for 2006, 30th June 2006 and 30th June 2007. For 2 years, depreciation has been taken on it. Getting it, students? And for plant and equipment, which method of depreciation we are using? Straight line or reducing balance? Reducing balance. We had calculated the depreciation on plant and equipment on reducing balance basis. So can anyone calculate the carrying amount of this plant and equipment at 30th June 2007? Can you calculate? 2 years depreciation we have to take on the 70,000. So carrying value would be how much? 70,000. How much depreciation charge has been there? 20% or 25? 20%. Still see, plant and equipment is being depreciated on the reducing balance basis at the rate of 20% per annum. So carrying value at 30th June 2007 would be how much? Multiply by 0.8, multiply by 0.8. If 20% is depreciation, remaining 80% is our carrying value. So for 2 years, we have to take the carrying value. So 30th June 2006, the carrying value would be 70,000 multiplied by 0.8. And 30th June 2007, again, we are going to multiply it with 0.2 to get the carrying. This is a quick method, okay? So how much carrying value will be there? 44,800 is the carrying value at 30th June 2007. Now two options are there: to sell the machine or to repair it and use it. So we are going to compare this carrying value with the recoverable amount. So carrying value we have calculated. Now sell the machine. A potential buyer has been located who has indicated that she would pay 80% of the carrying amount. So selling the machine is giving us an option that 80% of the carrying amount at 30th June 2007 can be taken. So how much? 44,800 is our carrying value. 80% of 44,800 would be our fair value. 44,800 multiplied by 80%. How much it is?
35840.
35840. However, she has insisted that the machine is repaired before she buys it. The repair work will be done by Hume's employees and will take about 120 hours of skilled labor. The associated cost with this labor is 2160. So the one estimated cost to sell is 2160. We are going to deduct 2160 out of it. In addition, Hume will have to deliver the machine to the buyer at the cost of 2100. This is again an additional cost of 2100. And there will be a single premium insurance cost of 580 for the journey. So this 580 is also going to be deducted. So this will be our NRV. How much NRV is there, students? 35840 minus 2160 minus 2100 and minus 580. How much? 31,000. 31,000 is our NRV. Got it? What is the second option? Second option is to repair the machine and continue to use it. This will be giving us the value in use. The financial controller has estimated that the present value of the cash flows generated from the future use, including the repair cost amount to $31,800. Is it? So they have given us straight away the value in use. The value in use has been 31,800. Is our value in use. Recoverable amount is greater of value in use and NRV. So which one is greater? 31,800. 31,800 would be our recoverable amount. Now see whether the impairment has occurred or not. Is your carry value more than the recoverable amount? So impairment has. How much impairment is there? Calculate. Impairment is 44,800 minus 31,800. 13,000. 13,000 impairment is there. Now, how are you going to recognize this impairment in your books of accounts? First, impairment has to be taken to the statement of profit or loss. So we are going to take this impairment to the statement of profit or loss. Students, it will be rough, but I will do it here. Students, we have written depreciation on property over here. Depreciation on plant also has to come. We have calculated depreciation on plant, is it? Or write it as well, otherwise you will forget. How much depreciation on plant has been there? 25520. And now we are going to write which thing? Impairment. Impairment of how much? We had calculated 13,000. 13,000 impairment will be written over here. Students, accrued interest we have not written. I wrote?
It's there.
Above, okay. Interest has, here it should be written. Anyhow. Okay, interest expense, impairment of 13,000 we have written here. And now impairment has to be deducted from our plant and equipment as well in our SOFP also. Okay, so two places impairment is going to be taken. Impairment of 13,000. Is everyone cleared? At which two places we have taken impairment? In our SOFP, we have deducted from our cost of the non-current assets and we have taken it to the administrative cost as well in SOP. Okay. All depreciation is charged to the cost of sales. Now, one more thing they have told us that depreciation should have been charged to the cost of sales. So in the examination, be careful because we have already written depreciation expense in our indirect expenses, but they are telling that you have to charge it to the cost of sales. Okay, it will not be affecting your final answer. Your final answer will be accurate, but recognition has to be done in the cost of sales. And the last, the directors have estimated the provision for the income tax for the year to 30th June 2007 at 6,500. This is the last thing. This is the estimated tax for the current year for which we have left this place. The current year estimated tax is 6,500. It goes to the SOPL as well as it goes to the current liabilities in your SOFP as well. So current year tax of 6,500 will be returned here. Cleared? Now calculate the profit or loss from over there. If it's a profit, you add it over here. Write the final answer here, and your assets should be equal to the sum of your liabilities and equity. Students, you have to do this question from your homes again, okay? Cleared? Shall we move on? Do you want to write? Actually, I don't want to take the picture of this poor girl. Okay. Okay, students, together with understanding number 4, do understanding number 5 as well from your names. May I please erase it now? I know the class timing is almost over, but I will be taking a little bit more time just to finish a few slides. Okay, not more than 15 minutes. Now, students, chapter number 5 is there, that is IFRS 5. Yes, IFRS 5. Non-current assets held for sale and discontinued operations. In this chapter, we are only going to discuss the small standard. From examination point of view, full-fledged question cannot come from this particular topic, but in multiple choice questions, they can ask you few of the questions out of it. So this is IFRS 5. Non-current assets held for sale and discontinued operations. Students, this standard deals with those assets which are held for sale during the accounting period of an organization. Sometimes during the life of the organization, during the going concern of the organization, few assets are held for sale. They are no more used by an entity in order to earn the economic benefits. So the general rule is that those assets which are fulfilling the criteria to be held for sale are going to be recognized separately, and they are not going to be depreciated anymore. We are not going to take a depreciation on these assets anymore. So this is important concept in regards to this. Moreover, this is not only included the non-current assets held for sale, but the discontinued operations as well. Sometimes a separate line of operations, say for example, in a full restaurant chain, one restaurant has been discontinued. So if any of the discontinued operation has been present in the organization, its results have to be shown separately from the continued operations of the organization. On the face of the profit or loss, we are going to show the results of the discontinued operations as a one-line item separately. So you are going to show the profit or loss for the year for the continued operations. Then you are going to write one line item more, profit or loss for the discontinued operations. You are going to add them both, and final result, total profit or loss for the year is going to be written. So now we are going to discuss about IFRS 5. In this chapter, we are going to learn about the reporting of the financial performance of the discontinued operations and assets held for sale. We are going to discuss about the full standard IFRS 5. We are going to discuss that which criteria has to be fulfilled in order to call a certain asset as held for sale. We are going to discuss about the measurement of the non-current assets held for sale, and we are going to discuss about the discontinued operations as well. What is the objective of IFRS 5? Students, generally the objective of IFRS 5 is to show the non-current assets held for sale separately. Why? Because they are no more giving us any economic benefit. So this is the first objective of IFRS 5. The second objective is for the discontinued operations. Those operations which have been discontinued, they are no longer going to give us the profit or loss. So we have to show their performance as a separate line item in our SOP. So they say the objective of IFRS 5 are to set out requirements for the classification, measurement, and presentation of non-current assets held for sale, in particular requiring that such assets should be presented separately on the face of the SOFP. So once the assets are fulfilling the criteria of the held for sale assets, they have to be shown separately. They have to be presented separately on the face of the statement of financial position. And updated rules for presentation of discontinued operations, in particular, requiring that the results of the discontinued operations should be presented separately in the statement of profit or loss. Together with the assets held for sale, those operations which have been discontinued, those particular major line of operations of the organizations which are not continued anymore. Say, for example, any branch of university is now discontinued. If this is the case, it has to be, its results have to be shown separately on the face of the SOPL. Now, students, what is the criteria to classify the assets as held for sale? In which situations we can call certain assets as the held for sale items? They say an entity should classify an item, a non-current asset, as held for sale if its carrying amount will be recovered principally through the sale transaction rather than through continuous use. So which assets are primarily called as the held for sale assets, which are now going to recover their amount by their sale, and they will no longer be used in the organization to earn economic benefits. For this to be the case, the following conditions must apply. So if these conditions which are given below are fulfilled, then we can classify a certain asset as the held for sale. The first one is the asset must be available for immediate sale in its present condition. Sometimes we do just think that, we just assume that in the future we can sell a particular asset, but we have not particularly made any kind of what we can say arrangement for that sale. In that case, once only the arrangement of the sale has been made, then we can call a particular asset as the held for sale. Only if we are thinking about the asset to be sold, at that time it will not be classified as held for sale. So the first condition is the asset must be available for an immediate sale in its present condition. The sale must be highly probable. Highly probable means that chances are more than 50%. And we are going to establish that chances are more than 50% when the management are committed to the plan to sell the asset. There is an active program to locate a buyer, and the asset is being actively marketed at the price that is reasonable. If these three conditions are there, we can consider that the sale is highly probable. Then the sale is expected to be completed within 1 year from the date of the classification as held for sale. If in the exam situation they are telling you that there is an expectation that after 2 years the asset will be sold, then it will not be classified as held for sale. Since the sale must be completed within 1 year from the date of the classification as held for sale. And the last one, it is unlikely that the significant changes to the plan will be made or that plan will be withdrawn. So basically 4 conditions are there which have to be met in order to classify a certain asset as the held for sale asset. Number 1 is that the asset is present in its immediate condition to be, in its present condition to be sold. Then the sale is highly probable. The third one is that it is committed that within 1 year from the date of the classification it is going to be sold. And the fourth one, there is no significant change to the plan which is being made for the sale of the asset. This one is important. How are we going to measure the assets which are held for sale? The assets which are held for sale are going to be measured at the lower of the carrying amount and the NRV. Got it? We are going to classify the assets held for sale as a separate line item in our SOFP. The value which we are going to write in front of those assets will be lower of the carrying amount and NRV. Okay, whichever is lower, at that price the assets held for sale are going to be classified. And held for sale non-current assets should be presented separately on the face of SOFP under current assets and not depreciated. Once the assets are classified as held for sale, they will no longer be depreciated anymore. So 2 points you have to consider under IFRS 5. Number one is that they are going to be recognized at the lower of the carrying amount and the NRV. And the second one is that they are not going to be depreciated anymore. Where the assets held under revaluation model and reclassified as held for sale, these assets should be revalued under method of IS 16, property, plant and equipment, or IS 40 as appropriate prior to reclassification. So before to the reclassification of the assets of IS 16 and IS 40, if they are under revaluation of the fair value model, first we have to recognize their revaluation gain in SOPL or other comprehensive income respectively, and then we are going to reclassify them as held for sale. Okay, and when we are going to classify them as held for sale, then we are going to compare these two values, the carrying amount and the fair value less cost to sell, that is NRV, whichever is lower at that amount we are going to recognize. Now students, from here we are going to discuss in our next lecture. Okay, so this is all for today. The questions which I have told you, you have to do them from your homework. Which one were those? Question number? No. From revision kit also I have told you few questions to be done. 221, 1 to 40 and 221 to 265. These questions you have to do from your home. Okay. So now students, this is all for today. I know you might be having a lot of questions, but once you are going to revise it, only then you will be able to ask those questions. Okay. So try to revise, and if you feel any confusion, then you can ask me. Okay, my online students.
Okay, miss.
Students, online students, if possible, try to attend the classes offline, because it's much better to understand F7. Okay. Okay, then see you in the next class. Goodbye, have a nice day.